Ladies and gentlemen, this is Aditya Malani from the HT Media Group. I would like to welcome you all to our second quarter financial year 2024-25 earnings webinar. As a reminder, all the participants will be in listen-only mode. After we are through with the presentation, there will be an opportunity for you to ask questions. With this, I now hand over to Ms. Anna Abraham, CFO, Hindustan Media Ventures Limited, and Head Investor Relations, HT Media Group. Thank you, and over to you, Anna.
Thank you, Aditya. Good afternoon, everyone. Welcome to our earnings webinar on the second quarter results of financial year 24-25. The results of Hindustan Media Ventures Limited was announced yesterday, and those of HT Media was released earlier today. Joining me on today's call to discuss the results are Mr. Piyush Gupta, Group CFO, Mr. Parvez Bajan, Head Financial Controllership and Taxation, and members of our Investor Relations team. Our comments during this webinar will follow the presentation slides. These slides and the financial statements are accessible on stock exchanges and on the Investor Relations page of our website. As we start with the presentation, kindly take note of the cautionary statement on any forward-looking comments during the call. In line with our usual practice, we would not be issuing any specific guidance on revenue or earnings. This slide gives our chairperson's comments on the performance of the company for the quarter, and I quote, "The second quarter of the current fiscal saw an improvement in the overall performance of your company. Our revenue grew and operating profitability increased. This performance can be attributed to our focused efforts on pricing, cost management, and efficiency, as well as a conducive business environment. The print business posted better numbers on the back of pricing-led advertising growth, which, coupled with our emphasis on operational efficiency, resulted in enhanced profitability. While the radio business was flat, the digital business saw considerable upside in revenue on a YOY as well as quarter-on-quarter basis, largely driven by growth of OTT play business in which we continue to invest. In the run-up to the festive season during the ongoing quarter, the company aims to boost growth on the back of a pickup in both retail and commercial market activity. Across businesses, we remain committed to enhancing the audience experience, bringing innovative solutions to advertisers, and engaging content to our customers." End of quote. This slide presents the agenda for the day. We will start with an update on the overall consolidated performance, followed by the business-wise segments, after which we will open for a Q&A session. With this, now I hand over the call to Mr. Piyush Gupta.
Thank you, Anna. Good afternoon, ladies and gentlemen. We'll quickly go over the second quarter's performance. So this is a view of the consolidated financial summary. As we can see, there's been a strong revenue growth on a sequential as well as a YOY basis. We've grown top line by 12% on a YOY basis and the same number on a quarterly basis as well. As you can see, there's a substantial improvement in EBITDA as well, and there's a positive cash flow during the quarter. Now we come to the business unit performance, straight away starting with print business. As is visible from the numbers, there's an improvement in print segment operating revenue led by advertising revenue on a YOY as well as a quarterly sequential basis. As our revenues came at 252 crores as against 244 crores in the same period last year, which is a growth of 3% and a 15% on a sequential basis. And our operating EBITDA came at a 19 crore against a marginal loss in the same quarter last year, with a substantial growth therefore. Moving on to English, as you can see, the advertising revenue has improved YOY basis commercial revenue and a quarter basis better volume in government segment. Circulation revenue rose sequentially, aided by higher number of copies. Coming on to the Hindi segment, there's a marginal decline in advertising revenue on a YOY basis. However, sequential improvement due to better yields and volume traction. Growth on YOY basis seen across key commercial categories except retail, FMCG and industrial. And there's a decline in circulation revenue on a sequential and annual basis. On a radio segment, operating revenue remains flat with a drop in operating margins marginally. Digital, we saw strong growth on a yearly basis across all segments, especially in OTT Play, and operating losses on account of investment in OTT Play continues as we continue to invest behind OTT Play. With that, we come to the end of the presentation. I hand it back to Alan.
Thank you, Piyush. We will now begin the Q&A session. You can click on the raise hand option, which will enable the moderator to unmute you for posing your query. Please introduce yourself before posing your query and kindly restrict to a maximum of 2 questions per participant so that we may be able to address questions from all participants. We will wait for a few moments while the question queue assembles. The first question is from the line of Deepak Sharma. Please introduce yourself and ask your question.
Yeah, hi, this is Deepak. I'm an individual investor. My question is on the OTT side. With Reliance Jio TV Plus, do we see a threat over there because they have the distribution? And, what's our strategy with that, behemoth, looking at us on something where we have been bleeding for the last couple of years?
Yeah, Deepak, great question. Look, we don't see a particular threat. So first of all, if you segment the market, Deepak, in Reliance Jio, this is basically going through the broadband, whereas our strategy is to go into tier 2 and tier 3 towns where broadband or fiber is not so easily available. However, having said that, we also have a Reliance Jio feed coming onto our OTT platform. So that's the latest tie-up that we have done. So that's also available. And the last point that I'd like to mention is the pricing. So Reliance Jio, of course, is bundled with the ISP service provider. Here, our pricing is very, very substantially competitive for the tier 2 and tier 3 towns, which we've been maintaining, we've been doing. So with the combination of that, I don't think there's a direct head-on competition. Market sets are very different. The product is very different. And the product delivery is very different. So on a OTT Play with a single login, you get seamless access to content, which you can scrape through a multiple platform. Unlike Jio, where you'll have to, once you are there, you'll have to open multiple platforms and get into this whole stuff. So, the content, the delivery, the pricing, and the target audience set is very different in both the products.
Sure, thanks. My question was on Jio TV Plus, which was launched last month, because I think that is operating in the same landscape.
Well, I off the cuff don't have too much details, so why don't we send those details across to you? But as I said, my first 2 part of the segment still kind of applies to that, because the target audience, even for a Reliance Jio TV Plus, because that goes through the broadband wire and the fiber, will still hold true. But on the third part, I'll check up on the content and let you know. But, more or less, the answer still remains the same.
Sure.
Thank you. The next question is from the line of Mehul Pathak. Please introduce yourself and ask your question.
Can you hear me?
Yeah, hi Mehul.
Yeah. Hi Piyush, Anna. Happy Diwali.
Diwali to you also. Season's greetings.
Happy Diwali.
Yeah, thank you. I have a few questions to ask. My first question is on Digi content. I had reached out to the company secretary twice, and second time I heard back from him in a very cliched manner. My question was that if HTDS is 100% subsidiary of Digi content, why is HTDS buying back HTDS shares? It will remain 100%. Usually a buyback happens when the shares for the shareholders are listed cheaply not, trading at intrinsic worth, and you want to return value to the shareholder. Now here the value, the shareholder is DG Content, but HTDS is buying back its own shares, which are 100% with DG Content only. So I never got.
So Mehul, let me try to address, and I can fill you on the details. Look, if you've analyzed the DCL balance sheet, you already know that there's a substantial loan sitting in DCL, and this buyback basically resulting into payback of the debt. Now, I understand your point of view that the cap table 100% subsidiary will still remain to be 100% subsidiary. But once you reduce the cap table and reduce the debt, etc., return ratios will improve. But I'll ask Anna to kind of elaborate on that as well.
Yeah. Mehul, happy Diwali to you too. I think Piyush addressed it. The cash, there is the cash generating company, it's SG Digital Streams. However, their parent company, DG Content Limited, does have a substantial loan, which impacts the consolidated results from the interest costs charged that the consolidated results bear on such a loan. And of course, there's a timeline for repayment as well. So therefore, it is important for DG Content to be able to pay back the loan. And since the cash is in the operating entity, the buyback enables the cash to be sent to the parent company for a repayment of the loan sitting in the parent company, which impacts the overall, benefits the overall financials of the consolidation.
Yeah, so apart from the return ratios improving, Mehul, you also have to understand HTDSL, which is the OpCo under DCL, is not being starved of any capital requirement. I mean, this is a surplus cash that it is generating and which is it is using to pay down the debt at the parent company level is all that is happening. So at the end of the day, it is accretive for shareholders only.
And Piyush, one thing is this was not, what you stated is not part of the company secretary's response to me. Okay.
Oh, okay.
Secondly, we all know, even there was a separate call with Anna when, the merger and all that was being discussed that I had, and we all know why the debt is there on the DG Content books also. Okay. Now,
well, the debt is there on the DG Content. If you've been, and Mehul, you've been tracking this company for a while, this entire business was purchased for a certain price and hence the debt came onto the books. Now, by multiple buybacks, this debt has been partially retired and therefore the return ratios are improving. And all this is happening whilst the operating performance in the wholly owned subsidiary is doing well and all the investments are going in. I think that's the sum and substance. So it is definitely accretive to all the shareholders in improving the ROCE ratios.
Yeah, I know, but when it's a 100% subsidiary, obviously, the very fact that is the finance structure designed, there is always going to be, some issue or the other in taking money from a subsidiary to the parent. So either in form of a dividend or a buyback or whatever. And I'm sure all this would have been thought through before having this sort of a financial structure. Nevertheless, my point is that all this financial engineering, optics are not healthy and doesn't look good.
So I'm sorry,
that is my feedback.
Yeah, we take your feedback. However, we are not doing anything which is inappropriate or not allowed by law.
No, I'm not saying that it is not.
We are following a process which is allowed by law to settle the financial liabilities. If the merger had happened, the financials and the entities would have looked different. But in the absence of the merger happening, which was also the privilege of the minority shareholders to decide, if there is a financial liability, it has to be settled. Otherwise, there are repercussions which fall to the company and its stakeholders as well. So we are with full disclosure, with full transparency, following actions which are important to settle the liabilities of the company as it exists.
And Mehul, sorry, just a point. I mean, this whole piece around financial engineering, stroke, the capital structure should have been known, etc., etc. I don't think I buy into any of this thing. This is all happening to improve the intrinsic value of the underlying value of the shares. I mean, if you are managing to retire your debt in a timely manner, I don't see what's wrong in it. And there is no financial engineering here. You tell me a better way of retiring the debt, I'll be happy. I mean, this is all happening because the operating company is churning out decent free cash flows.
in future, how do you plan to transfer profits made by the HTDS to
You know,
DigiContent? Is it always going to be just buyback?
No. Mehul. The debt is finite. Operating performance is good. Once the debt is retired, everything belongs to the shareholders, right? I mean, whether it will be a dividend, whether it will be something else, I can't say right now. But at the end of the day, whatever cash is being created belongs to the shareholder. Now, whether a dividend will be announced or it will be reinvested back into the business, I can't say now. But you know as well as I do that this is only improving the return ratios of the company. I mean, this whole piece around financial engineering, I don't know what is financial engineering here.
Anyhow, even if you buy back another 50%, DigiContent will remain the 100% owner of HTDS. That is my point.
We are not trying to change the ownership, Mehul. We explain why we are doing it. I think we've made our point. We will move on from this, please.
Okay. The second thing is, I am in the past also I raised this point. Feedback to the DigiContent board. The board meeting, quarterly board meeting gets over in 25 minutes. I don't know how you can do a business review of a company in 25 minutes when you are not shared even a rupee with the shareholders in the last 3 years. So, well, you might say that it is enough, but I'm just saying that these are observations.
Well, Mehul, I'd rather not comment on this whole thing, but I can tell you, the meetings, the shareholder meeting, the board of directors meeting, there's a proper review which is done on the business performance. All the feedback is taken on, on board. Now, whether 25 minutes is good enough or not, I really don't want to comment on that, but that's a full-fledged review is always undertaken.
No, it's okay. Piyush, my point is, can you please convey my feedback to the board?
Yeah,
that's all I'm saying.
Yeah, Mehul, we also have the shareholders meeting of the DCL. You are welcome to join there and share the feedback directly as well.
Yeah, because I have not seen any other company. Piyush, if that is possible, many other companies should be able to do that. Only DigiContent is able to finish in 25 minutes and no other company in India. I have not seen.
Fair enough, Mehul.
Third point, on the Hindustan media, I have seen there are 2 new investments, in the notes of accounts and even in the covering note of the quarterly result. Can you please share what these investments are, and what is the strategic objective of these investments in the HMVL quarterly report?
Well, let me get back to you. I don't know what investments OTT plays the single biggest investment where we are investing, and I think
HMVL, there are 2 investments. If you don't mind, I'll just take a second and read it for you. There is one of 8 crores and one of 56 crores in this quarterly report.
Okay, Mehul. So let us study. We'll come back to you. Let me just get my hands on it.
There is, first is in Samas Technologies Private Limited and Appreciate Platform Private Limited.
Mehul, these are AFE investments which we undertake, and you know the AFE model. These are AFE investments. If you do a Google search, you'll understand these are AFE investments.
What is AFE?
The ads for equity, which is a cash neutral platform where we invest ads against equities. I think you're aware of that.
Dear participant, sorry to interrupt at the moment, but we will request you to fall back in queue, please, for any follow-ups.
Okay.
Thank you, ladies and gentlemen. In order to ensure that the management is able to address queries from all participants, please limit your questions to 2 per participant. The next question is from the line of Rakesh Wadhwani. Please introduce yourself and ask your question.
Hi team, thank you very much for the opportunity. I'm Rakesh Wadhwani from 9 Rivers Capital. Sir, my question is with respect to the ad revenue. We have seen a very good improvement in the ads business, print advertisement in the print from the English, and lesser growth or the degrowth in the from the Hindi. Any reason for that?
Yeah, so there's been the commercial revenue even for Hindi has actually grown fairly well. However, overall revenue for Hindi is slightly depressed because of government revenue. So the share of government revenue in the previous year was substantially high since it preceded a national elections. And therefore, there's that government revenue has seen some softness in the Hindi, and you will see that consistently in the industry and not just for us. And that's impacted the overall growth for Hindi. Commercial, even for Hindi, continues to be healthy.
Okay. No, because other players in the industry, their revenue degrowth is far like a big, more than ours. Ours is 2%. For other players, it is more than 5%. That is a very good thing. But any reason why? I'm talking year on year. I'm not talking quarter on quarter. Quarter on
YOY itself, so quarter on quarter, actually government revenue has substantially improved because quarter one had the code of conduct, because of which there was a depression in the volumes from the government advertising. And therefore, on a quarter the government volumes have improved. I am talking YOY itself, and both the industry and us are seeing a decline on the account of the fact that base had a significantly higher government revenue as it preceded a national election, and that revenue is slightly subdued now. Commercial revenue has grown.
Well, understood. One more question from my side. With respect to the future upcoming, how do you seeing ad rates as well as the print segment, also advertising segment growing for both Hindi as well as English?
So, as we have spoken in the past, we've been on a journey to improve our pricing in the print advertising, and we have seen success in the last 2 quarters. So the pricing has improved for us consistently, and therefore that should hold us in good stead. Festive has been a fairly decent start, and we just hope to keep the momentum up for the rest of the quarter, and it'll depend on that. There are certain economic fact indicators which is showing a slight plateauing in the overall economic environment and the consumption patterns, which could see some pluses minus here and there. However, on pricing, etc., we've been able to achieve what we've set out to do to some extent.
And with respect to the demand for the advertising across Hindi as well as English belt, we are getting the same demand, or one English belt is getting more demand and more ad rates, and the Hindi belt is getting lesser demand and lesser rates? Across both are same, or
yeah, we are seeing similar uptick in commercial revenue. Of course, category by category, and depending on their relative importance in their various markets, there could be some changes in growth.
Okay. With respect to the circulation, we have.
Sorry to interrupt here. May we request you?
Sure. Fine. Thank you.
The next question is from the line of Deepak Sharma. Please unmute yourself and ask your question.
Yeah, hi again. Sorry. So earlier this year we invested into Easy Diner. Is that the same methodology what Mehul was asking? And could you just explain more on that?
Yeah. Okay. Yeah, that's the same methodology what Mehul was asking, and I think in the previous investors interactions we've covered that. This part of our business is the ads for equity business, whereby we take investment positions in multiple companies. And we don't invest cash. It's basically the advertising commitment that we give from our side. These are long-term contracts. Of course, there is a classical investment process of valuations and various other terms, etc., which are agreed, basis which all these investments are made. The Samas technology, which Mehul was saying, and the Easy Diner, which you are referring, are both part of the AFE portfolio. And I think I've comprehensively discussed this, in the earlier calls. This is a pretty substantial part of our business and a pretty profitable part of the business as well.
Okay, so there is no risk to the. So it's not a typical investment which you're doing. It's just only the barter part of it. What I'm able to understand.
Yeah, think of it like this. Yeah, exactly. Risk in a sense, I mean, of course, it's a minimalistic risk, but it is a barter in a manner of speaking.
There's no cash at risk.
Okay. So if the guy can refuse to not advertise into our system, that's all.
Yeah, that's all.
Okay.
Thank you. The next question is from the line of Rakesh Wadhwani. Please unmute yourself and ask your question.
Hi team. Thank you for the follow-up opportunity. I have a second question with respect to the circulation revenue. We have seen circulation revenue coming drastically across Hindi as well as English format. In English format is lesser, like the negative growth is lesser, but in Hindi the growth is very high at 12%. Any reason for that?
So English, we have actually grown circulation revenue on a sequential basis, and it's kind of flat on this thing. Hindi has seen some decline in copies, but it is across the industry. The commodity had been heightened over the last 1 year. It has come down to slight reasonable levels at this point. So the entire industry did see some correction in the copy. So no impact on share as such, but correction.
Yeah, but and also just to add to what Anna is saying, and whilst we are speaking, I mean, this whole rationalization of unproductive copies, etc., which happened, brought it down. Our realization per copies are absolutely intact, and market by market, wherever there is an opportunity to take a print order, we are on that journey any which ways.
Okay, because if I can correlate, the lesser the circulation revenue or the lesser the circulation, it impacts the ad yields also. So it should not happen.
And that's the reason I said the unproductive copies. So of course it does. So, you know, there is by market, by edition, and looking at the competitive position, you keep on optimizing the copies. There are some markets where you will bring down the copies because they are unproductive and they are not doing anything to your pricing, therefore the ad revenue and circulation revenue. But there are markets you will be increasing your copies because there's a bigger opportunity to take a bigger market share of ad revenue and therefore get the circulation revenue going as well.
For the full year, what will be the circulation revenue growth, or it will be degrowth for full year? Any guidance on that?
Well, there's no guidance on that, but I can tell you that, the philosophy is to serve the market to the market's capacity. And obviously, as you rightly pointed out, revenue is the clear yardstick. So as long as you can grow readership to a level which will drive revenue, we will do that. But just putting in copies where it doesn't have a commensurate impact on the revenue is not something that we'd like to do very often.
Okay. One last question with respect to the digital. I'm little new to this company, so forgive me if my question is very simple. So in digital business, what we are doing, we have an app, and how's the revenue model or how's the business work? Can you explain me in a small?
So it varies a little bit depending on whether you're looking at HT Media Consolidated Digital Segment or Hindustan Media Ventures Limited Digital Segment. So in Hindustan Media Ventures Limited, the digital segment only pertains to the business that we have incubated from last year, which is called OTT Play, which is an aggregator model in the OTT space. So we are an aggregator of various OTTs. However, we offer the content through a unified single login platform and not just a bundling process. So that's OTT Play, and the revenue there is from subscription of the various packages that we have, which we are offering to the customers. When it comes to HT Media Consolidated Results, the digital segment additionally has some other businesses like Shine, which is our jobs portal and jobs and learning portal. It also has the Mosaic business, which has properties such as the VC Circle and Tech Circle, which is in the venture space and the tech SaaS space, and a small business called Digital Entertainment, which is into digital streaming on a YouTube channel. So those are the 4 businesses which come in when we talk about HT Media Consolidated.
Okay, that was very helpful. Thank you very much, and Diwali wishes in advance. Thank you.
Thank you.
Thank you all. With this, we come to the end of the Q&A session. If you have any further queries, please reach out to the Investor Relations team. Our contact details are given in the presentation and are also mentioned on our websites. I now hand over to Piyush for closing remarks.
Thank you, ladies and gentlemen, for making the time to join the quarterly earnings call for Q2 I wish you and your family members, season's greetings and a very happy and prosperous Diwali. And we look forward to seeing you in the third quarter's earnings call. In the meantime, if there are any questions or clarifications that you require, please feel free to get in touch with our investor relations cell, and we'll be more than happy to furnish the information. Thank you so much, and all the very best.